CCA SBR students, how are you? I hope you are doing fine wherever you are. It's your ACCA tutor, Mr. Jerry Mutimkulu. You may call me Ango J. In this week, we are going to look at leases, among other issues. Yeah, here will be, in week 6, will be dedicated to financial instruments, income taxes, and leases. All right. So I'm sure you have seen the majority of my videos where I try to uh, explain accounting and various issues in the simplest way possible. But I've received numerous requests that I should try to bring the situation as closer enough to the students' experience as possible. That is to include a lot of examples, which are, exam oriented. Because if I, smooth teach you, the exam day is going to be brutal for you. So I try to ensure that all the examples relate to the examination at hand. So if you are actually going to write or to sit for the ACCA Strategic Business Reporting exam come September 2026, December 2026, March 2026, or June 2020, March 2027 and June 2027, this video is for you. Even after that period, it will still be most relevant, hopefully. Anyway, leases. We now have got IFRS 16, that is International Financial Reporting Standard number 16. So if you have been quite away, or you've been dealing with your leases using IAS 17, then you're actually in the wrong era. Okay, yeah, this standard was published in 2016, actually 2016, although it became effective after the financial period of 2019, that is beginning of 2019 henceforth. The standard is still considered new, which means examiners are still interested and will continue to be interested as long as there is no other standard that supersedes it. That said, we need to be very, very prepared and ready for requirements relating to this standard. Basically, the standard itself specifies, the principles for recognition, isn't it? Yeah, principles for recognition. Principles relating to measurement. The recognition of leases, need to be able to recognize leases, to measure leases, to present leases, as well as to make any relevant disclosures relating to leases. So you can see that this standard is very, very essential for our diet as accountants, as auditors, as corporate advisors. All right, guys, I told you my name. No point repeating it because it is written on the screen, isn't it? Jerry Mtimkulu, right? A fellow of the ACCA, also a graduate of the Corporate Governance Institute, a holder of an MBA from the prestigious Midland State University. in Zimbabwe, of course. Yeah, that's where we are located. And also holder of a master's in Masters of Commerce in professional accounting and corporate governance. Obviously, the rest can be seen there. So feel free to get in touch with me on WhatsApp 24/7 or through email them. All right, that's how we can interact and make the world a better place to live in. Anyway, without talking too much, let us just jump into, the problem why we don't want to jump into straight away is that, hey, this standard, this standard, this standard is so scary, is it? Scary. Anyway, we have already spoken about much of the peripheral material, but we need to actually talk about the essence why this standard was brought about and why the old one was phased out. There has been a lot of corporate scandals and a lot of misinformation in the capital markets where a lot of transactions were not being captured by entities' balance sheets or by the statement of financial position, especially when we were talking of operating leases. They would be involving large sums of money, but they were not captured by the statement of financial position, which is the snapshot of a business financial health at a given time. So, recognizing that mismatch, the International Accounting Standards Board, ISB, decided to come up with something so useful to the market. That is why we ended up having IFRS 16. So in adopting the new standard, all leases will now be brought on the statement of financial position. By who? By the lessee. Okay? By the lessee. Hey, spelling of lessee. Sometimes it's problematic, isn't it? By the lessee. The lessee. Okay, or the customer, or somebody who is, renting somebody else's property. Yeah. So, lessees are now required. I'm saying lessees, please be careful there. Lessees are now required to report in their statement of financial positions. These leases, they have to be reported there, and by the end of this, we'll be knowing how to do the reporting. Okay. But for now, at this particular juncture, just know that LSC, somebody who is renting out, somebody who is renting out somebody else's property, is required to account for the lease transactions in their records, in their statement of financial position, except in the following circumstances where the lease is for a very short term, usually less than 12 months. All right, where the lease term is 12 months or less and containing no purchase option. After the lease year, you are not entitled to purchase the item. You need to return it to the owner. So in that situation, you can be exempted to apply the full wrath, to apply the full requirements of IFRS 16. You will be exempted. So the exemption doesn't mean that you are not going to record the transaction in your books. It only means that you are going to be treated with, light gloves, isn't it? You'll be treated with some, VIP considerations. All right. So you are only required to expense. You need to expense the rentals to the profit or loss on a straight line basis. What is a straight line basis? We are simply saying that you are going to charge the same amount at every year end to your SP, to your statement of profit or loss, the rental expense. You are going to expense it to the P&L. Isn't it so easy? Very easy for low value items. All right. Some of the items might, in terms of money, because what we call low value is an amount less than $5,000, less than $5,000. That's a low value asset. So if you are renting something whose value is less than $5,000, like a personal computer and so forth, or an office furniture like a chair I'm seated on right now, then you can expense those things to the P&L. All right, you're allowed to make such exemptions. But you might say, in our country or in my jurisdiction, $5,000 is quite a lot of money. Yes, in your jurisdiction, it's a lot of money, but on international stage, remember, these are international financial reporting standards. Am I talking to somebody? Good. So they are looking at the world of commerce from the global stage. So 5,000, anything less than 5,000, that's not money. Okay, that's low value. That's low value. But from 5,000 upwards, yes, we are starting to talk now. We are starting to talk. Is that clear? So are you saying my Honda Fit? Yes, if its value is less than $5,000, that's a low value asset. If it is above, we are not talking about Honda Fit. We are also talking of various other cars, the Nissan cars, Nissan Goes, you know, a lot of them. Okay, just a lot of them. Anyway, we are not talking about brand names of cars and so forth. Please, please, please bring your mind to ACCA SBR. Okay, we are talking of SBR. Now, the other thing I need to mention here is about the treatment of these exemptions. When you choose to treat to apply exemption on the basis of lease term, okay? If the lease is 12 months or less, then you need to apply that. You need to apply that exemption to the full class of the underlying asset. If so, all the assets in that class are going to be treated based on all leases in relation to that class of assets have to be treated on the same exemption. Now, if you then use the exemption of low value, if you're using the low value, then you're allowed to treat, to apply exemption on a lease by lease basis. On a lease by lease basis, which means that you might be having computers from which you are leasing from company B and computers which you are leasing from company D. You may treat these particular computers maybe as you may treat them in a different way. So that's on a lease by lease basis. So each lease would be having its own peculiarities. Peculiarities. Okay. Is that clear? So on a lease by lease basis, I think I have explained everything here about the overview. Let us try to push it further with an example. Google leases out a machine to Ranco under a 4-year lease, and Ranco elects to apply the low value exemption. So he chooses to apply the low value exemption. like I said, even if you choose to apply the low value exemption, it doesn't mean that you are no longer using your senses. Your senses should continue to work. The terms of the lease are that the annual lease rentals are $2,000 payable in arrears. So we are going to pay these, rental for a year at the year end, isn't it? At the year end. However, there is an incentive from Gogo. She says Ranko must pay rent after year one. All right. Which means rentals which are due are only due in year 2, year 3, year 4. So in year 2, he will pay these rentals at the end of year 2, not at the start of year 2. Otherwise, the year 1 rental will cease to be free. Is that clear? Year 1 is rental free. Bear this in mind. All right, let us have our timeline. We are having year 1, year 2, year 3, year 4. Year 1 is free. Year 1 is free. But year 2, you need to pay 2,000. Year 3, 2,000. Year 4, 2,000. So we are going to have a year 5 somewhere. Why year 5? Because year 2 rental is going to be paid in year 3. We are paying in arrears. Am I talking to somebody? If I'm talking to you, please just write something in the comments. Write something, my friend, my sister, my brother, my dear student. Write something to say, Uncle J, you are just sharp on it. You are spot on. Okay, so year hello. Year 1, I said it's 0. You're not going to pay anything in year 1 according to Go. This should be a grandmother. So benevolent. In this era where rental costs are so high, she's offering somebody, a free ride for the full year, for the full 12 months of the year. And then she says, you are going to pay the rentals in arrears, which means, hey, this Rango enjoyed year 1 and the most of year 2 and only had to pay at the end of year 2. So at the end of year 2, that's 31 December, which is the beginning of year 3. So we are paying in year 3, actually in essence, isn't it? Then year 3 rentals are paid at the beginning of year 4, and the other one at the beginning of year 5. Is that clear? That's where we pay. Our last rental is going to be paid on 31 December. On 31 December of year 4, which is almost the start of year 5, isn't it? That's the start of year 5. So we are simply saying year 2 is not being paid at the start of year 2 because there are rentals in arrears. So they are paid at the end of year 2, which is the beginning of year 3. This is why we put the R on year 3 and year 4, year 5. So one thing you have also discovered, we have our time. Please allow me to explain. Good. So one thing you should have discovered is that only 3 rentals are going to be paid. Why? Because year 1 is free. So 2,000 multiplied by 3, that is 6,000. Or you can actually do it manually. Year 2 rental 2,000, year 3 rental 2,000, year 4 rental 2,000. And this comes to 6,000. IS 16 requires that even if one of the periods is going to be free, the lease rentals are going to be spread across the whole lease term. We are talking of the lease term. What is the lease term here? The period where the lease cannot be cancelled, the uncancelable period of the lease. And this is the 4-year term, the 4-year term, the 4-year term. This one, this year 5, remember, is just a notional year. It's a notional year. It's not part of the lease term. The lease term is year 1, 2, 3, 4. Am I talking to somebody? Good. So we are talking of 4 years. We're talking of 4 years, and the total rentals for those 4 years is 6,000, as we have found out there. So each year is entitled to a rental of 6,000 over 4, that is 1,500. Is that clear? Am I talking to somebody? Good. So now, how J, you are saying each year is now entitled to 1,500. But Gogo said, I don't want your money. Rango, I don't want your money. All right, keep it. You start to pay me at the end of year 2. So in accounting terms, because we need to think about this with the pre-populated spreadsheet in the exam, you'll be given a pre-populated spreadsheet where you need to put some figures either in the statement of profit or loss, or in the statement of financial position, or in the statement of changes in equity, or in the statement of cash flows. You need to be alive to the fact. Is that clear? Good. So now, we come back to the drawing board and say, what is happening here? Gogo doesn't want man at the end of year 1. So what am I going to do as an accountant? You have already discovered that every year there should be an expense on a straight line basis. So in year 1, even if Gogo doesn't want man, we don't care. Okay, for the SPL, for the statement of profit or loss, in year 1, I'm going to charge an expense of 1,500. Year 2, 1,500. Year 3, 1,500. Year 4, 1,500. I'm going to go, to expense this. Every year I'm going to expense. But now, I have done the expensing. I've done the expensing. But Gogo doesn't want the money. So I'm not required to pay the money. But using the substance over form, or using, not the substance over, but the matching concept, I've enjoyed the rental. Even if it was free, I need to charge. This is actually very consistent with IFRS 15. You know, the standards are now consistent to one another, isn't it? I've enjoyed the service. I need to pay for it, isn't it? So, the SFP now, this expense, yes, it's an expense, but was not paid for. All right. This year is a free year. This is a year for free lunch. So this 1.5 has to be paid by the other years where there will be cash outflows. So it means that I need to divide that 1.5 by the number of years where the rentals will be paid, which means the 1.5 should be divided by the 3 years, 3 future years, which means every year, each of these years should also be my 500. The year 1, 500. Year 1, 500. Is that clear? So what am I going to do? All right. I said in the statement of profit or loss, the rental expense would be 1,500. 1,500 every year, 1,500 every year. However, we then have to say in year one, there is going to be in the SFP, because there was an expense of 1,500, but it wasn't paid. So there is going to be under liabilities. Okay, both the current and non-current, because the non-current under liabilities, okay, the non-current liability would be $1,000, and somebody can say, can tell me why, and the current liabilities will be 500. Why is it so? Because this is the current. This is current. The first one is current, but the other one is longer term. It's not going to be, uh, it's not going to be paid within 1 year. But what is going to be paid is the first 500 in year 2. Okay, so remember, this is year 1. In year 1, we are going to recognize a liability or an accrual. Actually, it is an accrual. This accrual, the accrual, okay, of 1,500. But this accrual, in essence, the accrual in essence is talking of monies which cannot be paid in the coming, all of which cannot be paid in the coming year. The 500 will be paid in the coming year, but the 1,000 will be paid after year 2 and 3. That is in year 3 and 4. Am I talking sense? Or somebody has been confused? Okay, let me just show you this explanation. An expense of $1,500 would be recognized through the profit or loss for each of the 4 years. So in each of the years, we are going to recognize a 1,500 expense. At the end of year 1, an accrual of 1,500 will be recognized on the statement of financial position, of which 500 would be released over the remaining 3 years of the lease. So we'll release the 500 for, over the 3-year period. Isn't it what I was talking about? So, for example, in year 2, let us do the journal for year 2. This year 2. In year 2, we need to recognize the expense. Let us talk of year 2. Year 2, we are debiting expense. What is the expense? 1,500. Rental, 1,500. Debit rent, 1,500, right? We're debiting rental expense, 1,500. Okay, it is. We are also going to talk of the other 500. Remember, the other 500 is a debit accrual. We are reducing the accrual, isn't it? Initially, when we created the accrual in year one, we debit expense, rental expense, 1,500, and credited accrual. There was an accrual of 1,500. That was year 1, isn't it? That was year 1. But in year 2 now, we are debiting the rental expense again. Remember, each of the years should have a 1,500, 1,500. So we are debiting rental expense for year 2, 1,500. We are also debiting the accrual. We are now amortizing the accrual, but we are amortizing 500 for the last 3 years, for the rest of the 3 years, for each of the 3 years remaining. So debit rent 1,500, debit accrual 500. This comes to 2. And credit what? Because we are now making a payment to go cash 2,000. Can somebody say, yeah, clap up, clap hands for me, please? Oh. So that's how we are going to treat this. That is in year 2. In year 1, no credit in cash. Why? Because Gogo said, keep your man Rango. Rango, keep your man. Oh. All right. So this is the expense per year. We have done the calculations. 2,000 multiplied by 3 years. 3 years, that is year 2, year 3, year 4. Is that clear? How do we identify a lease? A contract is or contains a lease if it conveys the right to control the use of an identified asset. So conveys right to control the use. To control the use is a very, very important phrase of an identified asset for a period of time. It's not going to be a lease forever. It is for a period of time in exchange for consideration. When it becomes a free lunch for the rest of the term, it ceases not to be a lease. When there is no specified period, it again ceases to be a lease. Okay, because if you're going to stay at my house forever, then automatically that is your house. You're not renting from me. Is that clear? Somebody might argue and say, but how will be paying rent? If the contract is specifying that you'll be paying rent forever, the forever is the time period, isn't it? Isn't it the time period? Let me look for my dictionary for that. Isn't forever a time period? So my dictionary is saying that a period of time includes an indefinite period. However, this standard requires that the entity has to determine the lease term. Okay, the entity has to determine the lease term, which includes the non-cancelable period. We have spoken about this, isn't it? The non-cancelable period of the lease, an optional renewal period. Okay, an optional renewal periods that the lessee is reasonably certain to exercise, and excludes periods after the lease can be terminated if the lessee is not reasonably certain to continue. So it might, okay, the lessor might be interested in having his tenant staying forever, but the tenant needs to participate in the contract to say, is he quite sure that he will be there after a certain period of time? Is that clear? So the period of time should actually be known. The lease term should be known. All right. An identified asset. Guys, the lease or the contract of lease should identify the asset. But I want you to be careful here. Identification can be expressed, or let me just say explicit, can be explicit or implied. Or implicit. Okay. Express simply means that the asset under consideration is house number 2024, Wedza Road, Harare. That's to explicitly state the asset in question. But sometimes the contract, the contract asset or the lease asset the identified asset may be, implied. For example, A knows that B has got only one machine, and this machine produces a certain type of products. And B doesn't have any other machine except that one. So in their contract, they only mention that they want a machine from B which can produce A, B, C, D, these type of things. But the particulars of the machine were not stated in the contract. But both parties were in the knowledge that there is only one machine that can produce that type of products. The contract is still relevant because the machine which is being referred to is only one machine which B has. That's the aspect of implication, or of implicity or impliedness of the contract. Let's talk of the right, the conveyance of the right to control the use, the right to control. This right to control, or let me just say the control itself, is conveyed when the customer has both the right to direct. So the customer becomes entitled to direct the identified asset's use, which means he's now able to enjoy it anyhow, the way they want it. Although in the contract, there will be certain clauses that you need to keep my building intact, you must not disrupt business around the locality or break the laws, something like that. Okay, those are the common contract terms which are not expected to disturb your enjoyment. But in the manner in which you have to close the shop, where you need to operate your business and this and that, all those ones will be some infringement to the right to direct the identified assets use. So if there are no such infringements, then you're actually having the control. But one thing more needs to be proven, that you are obtaining substantially all the economic benefits from that use. So you're actually having the maximum usage, the maximum economic benefit from the use of the asset. If you are having the maximum benefit from the use of the asset, or the substantial benefit, then we can say you have control. You now have the control. So both has to be. Sometimes you might be having the maximum, but you are not in a position to direct the usage leading to that maximum benefit. You are not. You are just at the mercy of the owner. If you are at the mercy of the owner, that's not a lease. But you need to have both. You are enjoying the maximum benefit at your own rules, at your own beck and call, at your own dictation. Is that it, ladies and gentlemen? Right. Now we are not thinking SBR. However, if the supplier, that is the lessor, the owner, has a substantive right to substitute the asset, during the period of use, then the customer does not have the right of use of the asset, and hence there is no lease. So if the landlord can actually tell you to say, hey man, I want to put my people in one of your rooms, if they say, let's say for example there are 2 rooms and they want to occupy one of the rooms just for the wedding that is going to come in 3 months, and they need to do some preparation of the room, and they take almost 4 months of the room. Remember, there is the word substantive. if the supplier has a substantive right, substantive means significant right to dictate. So the right is so huge that they can tell you that for the major part of the year they'll be using the building, and then they'll give you maybe for the remaining part, and they tell you that yes, you continue to pay the rent. Even if you are paying the rent, that is not a lease agreement. Hello, hello. So sometimes the use of the rent, the word rent will be there, but the recognition criteria for a lease is not met. Why? Because you do not have control. You are paying rent, yes, you need to just expense that rent straight away. Do not recognize any asset in relation to that arrangement. Why? Because you do not have the right to direct the asset, to direct the use of the asset. Is that clear? I think I've spoken a lot. I need some figures now. Anyway, let us look at this example to see if we can identify a lease in these stories. So don't forget about the names. The names may be familiar to you, but these are just hypothetically imputed, hypothetically, endorsed here. All right, they are not referring to anybody. For each of the following scenarios, explain if the contract is a lease or if it contains a lease. Number one, Stickers needs to transport its goods to customers in America using rail freight. Freight. Sorry. So they want to transport their goods to customers in America using rail freight. Rail freight. English mama. Okay. The company enters into a contract with a rail freight carrier for the use of 10 rail cars of a particular type for 5 years. So they enter into a contract with a rail freight supplier or carrier, something like that, for the use of 10 rail cars of a particular type for 5 years. You need not to know or to have experience in rail freight business. No way. You're not required to have that type of exposure. But you just have to understand the key signals to something. This is why I said accountants need to be clever. You need not to be an engineer for you to be able to audit an engineering business. You need not to be an ICT expert to audit their business or whatever they do or whatever or their department. You just have to know signals. There are key signals you need to be aware of. Here, leases are contracts, and contracts can only be administered properly by lawyers. But when you go to lawyers and talk about these things, they won't understand them. Even if you are talking of contracts, but they won't understand. But when you want to draft a proper lease, you need to have a lawyer. So this interchange, but the lawyer, when it comes to application, financial application, he won't be able to come up with the proper ledgers for the contract which he signed. So they call themselves learned people. Yes, in their own legal discourse or legal fraternity. But when it comes to reporting issues, financial, then Mr. Accountant, oh my God, he's an angel. Anyway, let's get back to the business. So what have we gathered on scenario one? Scenario one, we have identified the contract. Okay, the contract can be identified here. The contract asset can be identified. All right, which is 10 rail cars. And these cars, not just 10 cars from a pool of cars, but of particular type, that is of certain attributes, which means they can be identified. For what period? For 5 years. Obviously, the issue of consideration was not mentioned, but can be mentioned. Can be assumed to be an obvious issue that nobody's going to give you those 10 cars for free. That one, we need to be told whether it is for 1 million or what. That one is not really important. So you can see that the first situation is talking of a contract. This is a contract, is a contract. The underlying asset or the identified asset here is 10 rail cars of a particular type. For how many years? For 5 years. There is a lease term there. And it will be used specifically to transport goods to customers in America, which means this rail freight carrier is not going to substitute the use of these assets once the contract starts to run. No substitution. Yeah, you can argue along these lines, and you'll be assured of your 2 to 3 marks. What about in situation 2? Edgar's needs to transport its goods to customers in America using rail freight. The company enters into a contract with a rail freight carrier that requires the carrier to transport a specified quantity of goods by using a specified type of rail car in accordance with a stated timetable for 5 years. What shall we say? They enter. Actually, the situation is just the same. The first line is just the same. They need to transport its goods to customers in America using rail freight. The company enters into a contract with a rail freight carrier that requires the carrier to transport a specified quantity of goods by using a specified type of rail car in accordance with a stated timetable for 5 years. So basically, they are now using the carrier to transport their goods. So they are entering into a service agreement. Okay. I'm sure I missed this part. I'll tell you which situations in which IFRS 16 is not going to apply. Okay. Now, we'll talk about those ones. They've entered into a contract with this carrier to ferry their goods to America to their customers on particular days, right? Particular days or according to a stipulated timetable for 5 years. For example, you need to transport these goods in June, right? Every June until the end of 5 years, using a certain type of a rail car. Maybe the bullet train, we do not know. All right, so is this a lease render? Is this a lease render? Let's look at the detailed solutions. Number 1, the identified asset is the specific rail cars. Specific rail cars in the contract to which the supplier does not have substantive substitution rights unless for repairs or maintenance. The customer has exclusive use of the rail cars so has the right to all the economic benefits associated with the use of those cars. The contract therefore contains a lease of the rail cars. This one is a lease. Number two, there is no identified asset as the supplier can use any rail car as long as it meets the specific type as designated in the contract, as long as it is a bullet train, which they want. But they did not specify which bullet train. If the supplier has got 10 bullet trains, he can use any of those. So that's not a lease, is it? As long as it meets the specific type as designated in the contract, which means that the supplier has substantive substitution rights. They may use bullet train A today. Next year, they may use another bullet train, whichever they want. They've got the right to pick and choose which asset to be used, which one to be substituted. As the supplier can choose which rail car to use out of the fleet, then they have substantially all the economic benefit of the rail car, and hence there's no lease within the contract. No lease. Is that clear? All right. I wanted to talk about situations when IFRS 16 doesn't apply. IFRS 16 doesn't apply to the list of biological assets, for example. It doesn't apply there. Also, the concessions, that is service concession arrangements, it doesn't also apply in those situations. There are various other, let me just look for them here. The other situations in which the standard doesn't apply is when we are talking of leases to explore for or use of minerals, oil, natural gas, and similar things. When we talk of intellectual property licenses, that will be dealt with in terms of if it's 15, all right, intellectual property licenses. Then the rights under licensing agreements, that is IS 38, and the service concession agreements, arrangements, which we've spoken about. All those are exclusions from IFRS 16. We just have to bear them in mind. Okay, there is a situation where now when you enter into a lease, the charges you will be paying include the lease component and the non-lease component. All right. You might, let's say you enter into a contract to use machinery from a certain company. Then they say, we are having one of our experts to look after your machine so that you continue to enjoy it. All right. If the expert is not going to be paid, okay, or let me just say, if the expert is going to be paid, he needs 20,000 per year. If you are using the machine without the expert, you are going to pay 100,000 per year. But if you are using the machine with the expert included, you are going to pay us 110,000. So we are simply saying the list for the machine lease is saying that the lease contract on its own is saying that you are going to pay just a lump sum of 110, right? That is, if you are going to enjoy the machine and maintenance, the maintenance. If you're going to enjoy both the machine and the maintenance, then you are going to pay $110. Remember, we are talking of thousands, so $110,000. But the machine itself, to rent the machine without the maintenance, the standalone cost would be machine. Let me just say Mac. The Mac is 100,000. You're paying 100,000. Then the expert for maintenance, the maintenance needs 20,000. So all in all, we are looking at 120. Don't mind my, my weirdness in typing. Okay, so standalone is very, very expensive. So if you simply pay for the bundle, you pay less. That's what we are talking about. All right. So how do you treat this transaction? This is the purpose of this subtopic, lease and non-lease components. How are you going to treat them in the books of accounts? Because the examiner is going to tell you, this company, if they're paying leases of 110, lease rentals of 110,000. These include the services for the rental costs for the use of the machine, as well as the maintenance costs, because the company has got an expert that is devoted or dedicated to that particular asset, and that expert is difficult to get. All right. If the machine is going to go without the expert, the rental is 100,000. If the expert is going to be hired, the expert's time is going to be hired without as an individual service or an independent service, he charges 20,000. So if you add up, you come to 120. Those are the costs on a standalone basis of these services. So this standalone information will be used to allocate the lease rentals here. The lease rentals to say this is the lease component and this one is the service component, the maintenance service component or the non-lease component. You need to separate the two. You mustn't bunch them. So a combined contract where part of the payment is for the lease of the asset and part of the payment is for the provision of additional services by the lessor. Then the lessee needs to split the rental into a lease component and non-lease component. The payment of the lease is to be allocated based on the standalone prices of the components. So this is how you split. So to split, obviously, we are going to say, I didn't want to use my tab, but I think I should use it now. Anyway, let me try to type. So the lease component in this 110 is going to be 100, which is the standalone cost for the machine, over 120, which is the total standalone price. The total here, which is 120 here. And this is the 100 I'm talking about. The 100 over 120 multiplied by 110. This is the 110 we are talking about. 110. And we get the amount to be allocated to the lease. Amount to be allocated to the lease. That is 110 over 120. I mean 100 over 120. What is that? The calculator. 100 over 120. That is 83%. Multiplied by 110. That is 91.67. 91.67. 91,670. 91,670. And the allocation for the non-lease component would be 20 over 120 multiplied by 110, and you get that amount. I think we'll do a more comprehensive example involving all these issues in the short possible while. Let's talk of lease accounting. How do you account for lease? Now that you have determined that the contract is a lease contract, there are certain basic computations which we need to be comfortable with, but we'll do them in the short coming while. Okay, in a short while. On initial recognition, at the start of the lease, the lessee initially recognizes a right of use asset and a lease liability. The lease contract liabilities are recognized at a discounted present value, and a right of use asset is recognized at the same amount. So they need to be at the same value, isn't it? They need to be at the same amount on initial recognition or at initial recognition, exactly. All right, and remember, they should, the contract liability, the lease liability should be at the discounted present value of all lease payments or all future lease payments. You get the discounted value or the present value of all those payments. Perhaps these definitions are essential for us. We need to milk them. All right. So I encourage you guys to first know the lease liability, what the lease liability is, so that you'll be able to understand the right of use asset. Because you will realize that when you then put these figures in the SFP, they tend to be different. But in the definition, we have here on initial recognition, there is a statement that they need to be of the same value. They are recognized at the same amount. But you will then discover that they tend to differ. All right. So first of all is the determination of the lease liability. All right. So the lease liability is measured at the present value of the lease payments payable over the lease term, discounted at the rate implicit in the lease. If this rate is not given in the lease contract, then we must use the incremental borrowing rate. The incremental borrowing rate, or the rate at which the entity will be charged if they borrow funds to purchase a similar asset. Am I talking to somebody? If they want to borrow money, what rate of interest are they going to be charged by the bankers to buy a similar asset? That's the incremental borrowing rate of the lessee. Is that clear? Good. So the contract normally will have a rate to apply. Lease payments include fixed payments, less any incentives. Fixed payments, like for example, every year we are going to pay us $1,000. less any particular incentive, which the lessee would have, certain payments from from the lessor. For example, the lessor might say, okay, fine, we're going to input in your account so that you'll be able to cater for certain services at the property, right? Those are the incentives you might be given. Or you are going to pay maybe you're going to pay us 1,000 less any 5% discount on your rentals. Those are the incentives, or those are incentives. They have got a tendency of reducing the fixed payments and ultimately the liability, isn't it? There could be some variable payments, which could be adjusted with some index, maybe they inflation adjustment and so forth. They need to be also accounted for. There could be payments related to the expected residual value guarantees. Okay, residual value guarantees. A residual value guarantee or guaranteed residual value, right? A guaranteed residual value is some sort of payment or some sort of assurance that we are going to, after the end of the lease, your property should not be below $1 million. After we use your property for 50 years, we can assure you that your property's value will still be at, say, 1 million as a minimum. We are guaranteeing that. So any potential payments in case the properties are not going to be at 1 million by that time, and an expected payment to say, okay, fine, there is a possibility that this property will be around 700,000 in 50 years. So the potential outflow is 300,000. So the 300,000 is the guaranteed the expected residual value guarantee payments. All right. Or the guaranteed residual value payment. Is that clear? Good. We are guaranteeing, we are promising the lessor that, this should be the residual value of the property at the end. However, there is a danger. There is a danger that the property might not be at that value, or might actually be at zero. If at the end of the year, the lease term, the property will be at zero, then there is a certain payment. Say, okay, fine. If your property will become zero by then I will assure you that I'm going to pay you $10,000. All right, good. So those factors are going to be factored in. This is why you need to use property experts when you want to enter into lease arrangements. Any penalty for terminating, if reasonably certain, if there is more likelihood that you may terminate at a certain period, then we need to factor it in the lease liability. Exercise price of purchase options, if reasonably certain that we may purchase this building, we can as well add that to the lease liability. Is that clear? So now, when you get the total of the lease liability, you can now then move to the right of use asset. We have been told that this should be at the same value with the lease liability. However, the right of use include the lease liability itself, plus, this is why I say you need to first of all start with the lease liability, because the full amount of this lease liability is in the right of use asset, plus initial direct costs, which are also going to be debited to this asset, estimated cost of dismantling are going to be debited here. Payments less incentives before commencement date. So you need to be very, 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 very conversant with this. Is that clear? Now, subsequently, how are you going to measure leases? How are you going to measure the lease items, the right of use, which is this one is the asset by its name, a son by its name, and this one is a liability. This one is just a liability. All right. So the right of use asset, the asset it is in the asset section of the SFP. This one is going to be recognized, to be measured at cost less accumulated depreciation. But remember, IFRS 16 leases allows the subsequent measurement to be at the end its choice, depending on the asset. Some might want to value using the revaluation or the fair value method, right? You might do so. You're allowed, all right? If you are adopting the IFRS 16 cost model, you are also allowed to do so, which means you can hold the cost at, the asset at cost less accumulated depreciation. Please note, depreciation is based on the area of the useful life and lease term. Sometimes the examiner will tell you that the lease term is only 5 years, but the life of the asset is 10 years. So how are you going to charge depreciation? Are you going to use the asset's life or the lease term? Depreciation is based on the area of the useful life and the lease term. So you, in that particular case, you need to use the lease term, even if the asset's life was given. But the lease, we are talking of leases. Unless ownership transfers, in which case use the useful life. However, so here we are simply saying that you need to read the whole scenario to get all the facts. If there is an option that the lessee can buy the asset at the end of the lease term, and there are chances that they will go for that option, then until then, only until then, you need to use the area of the useful life and the lease term, unless the lessee wants to buy the asset and they are likely to buy it. This is the subsequent measurement for the lease liability. This one is going to be considered a financial liability at amortized cost. At amortized cost, which means we need to use the amortization table for the lease, isn't it? Or the liability table, amortization table. Let's now look at the thing which we touched in part and parcel, the lease and non-lease components. This one, this example might be more useful to us as we venture into critical lease accounting issues. On 1 January 2021, Gabriela enters into a 3-year contract for the use of an item of machinery and its annual maintenance for a combined total of 100,000 per annum, payable each year. The rental of the machinery without any maintenance is 95,000 per annum, while its a standalone maintenance contract is 10,000 per annum. Gabriela can borrow at a rate of 5% a year. Explain how the above will be accounted for by Gabriela in the year ended 31 December 2021. So we now need calculators here. So we need to do the allocation, and we have seen in the previous example when we were introduced to this subtopic on lease and non-lease components, we managed to allocate the whole sum transaction price into the lease and non-lease components. We can still do the same here. All right, we can still do the same. So, for example, we are told that the combined amount or combined total is 100,000. Is 100,000. And this can be allocated as follows. We can allocate this one as we first of all need to know the prices for standalone goods or services. So the lease, which is, remember, the identified asset here is the lease. In the lease is the machinery, right? This is the item to be used. However, it is to be subjected to annual maintenance, right? So they go hand in hand. The lease rentals go hand in hand with the maintenance, but we need to separate them for presentation purposes. So we are going to say 95, which is the standalone price for the machine, or the standalone rental for the machine, and 10,000, which is the standalone price for the maintenance service. So we add them and we come to 105. So the 105, this is 0. Okay, it's a 0, this one. The 105 is our base, okay, or our denominator for allocation. The numerator being the standalone prices per each category. So for the lease, we are talking of the machine price or the machine rental, that is 95. 95 over 105 multiplied by 100,000, which is the amount at the top here. So that's 95 over 105 comes to 9.47% multiplied by 100,000. We come to 90.476. So we come to 90,476,000. That is the amount for the what? For the lease component. What about the other item that is maintenance? Maintenance now. So this one is lease. This one is for the lease. This is the lease portion. The maintenance now. The maintenance cost, maintenance or non-lease. This is the non-lease. The maintenance would be 10. This 10 over 105 multiplied by this 100,000. All right, and we get 10 over 105 multiplied by 100,000. That's 9,524. So if you add these two figures, if you add them, if you add this amount and this amount, they should add up to 100,000. Then if you could come up with the 100,000, then you can tell yourself that you have asked that question. Just cross-check. They add up to 100,000. Okay. Now, that's the lease component. But remember, we need to then determine, we then have to determine The lease liability, actually, yeah, we need to determine the lease liability. And what is the lease liability? It is the present value of all the lease, the future lease payments. So each year we are going to pay how much? Each year we are going to pay the lease component. Remember, the non-lease, this maintenance is a non-lease. That's a non-lease component. It has to be excluded when we are computing the lease liability. That one is just an expense directly. That is to be expensed to the P&L. Okay? In the statement of profit or loss, just have to, that's a P&L debit. That is debit non-lease cost or simply maintenance cost, debit maintenance 959524, and credit cash or bank. Are we together? 9524. You're not crediting any liability there. It's not related. It's not related to the lease. It's a non-lease component. Non-lease component, debit P&L, debit maintenance 9524, credit bank or cash 9524. Are we together? Okay, guys, going ahead with our discussion. So we have managed to delineate the transaction between the lease component and the non-lease component. So we then have to determine the lease liability, and from the definition, it is the present value of all the future lease payments. All right. So we come here and do the working. Now we have determined that the lease component is this amount. So for us to determine the present value, we have the years. Remember the present value table, the years, the cash flow, the discount factor, the present value. So year 1, year 2, year 3. Because remember, this was a 3-year lease. So the amount we are looking at now is this one, 90,476. 90,476. So the discount factor at what percentage? At 5%. At 5%. So discount factors, we need calculators because all right, so the discount factor should actually be for year 1, that's 1 over 1 plus R. Our R is 5%, so that's 1.05 to the power 1, which comes to 1.05. So that simply means that, and you have this calculator, what are you? That's 90476 multiplied by 1 over 1.05. It comes to 86,168. All right. We come again to this one for, 9476. 9476. Remember, these are the lease components every year. Those are the lease components every year. They will be subjected to the discount, to discounting. So in year 2, that's 1 over 1.05 to the power 2 now. To the power 2. Okay, I think I need some scientific calculator. So that's 90,476 over open bracket 1.05 to the power 2. And it comes to 82064. In year 3, that's 1 over 1.05 to the power 3. So it's now to the power 3. That's 78157. Then you get the total. This is the PV of all the lease payments. So this would be the lease liability to be recognized. So the total there should be, all right. So that's 86168 plus 82064 plus 78157. So that's 246,389. 146,389. That's our lease liability. So what are we going to do? We are going to straight away come with this journal debit right of use asset, row asset, the right of use asset with 246,389. 246,389 and credit lease liability 246,389. So on inception, we're going to recognize a right of use asset of 246,389 and a liability of 246,389. That is the same amount. Is that clear? However, the right of use asset, ladies and gentlemen, still needs to be modified. But in this case, seems no such modifications are necessary. Okay, so certain modifications necessary could be whatever incentive, if there was some incentive or some direct costs which were required by this company who owned the machinery. If there were certain direct costs, paid to obtain this particular lease, then we were going to include them, less any incentive, if any. But such type of thing were not cited. So the ultimate lease liability and the row are just the same. Anyway, let's now go to the subsequent situation, all right, at the end of the year. So at the end of the year, we'll realize that since it was a liability, there are interest costs or finance costs associated with it. So we need to come up with our amortization table. We need to come up with the amortization table to understand what is going on. And the presumption here is that the rentals were being paid at the end of the year. Not in advance, but at the end of the year or during the year. That's the assumption, right? Okay, so we come here and have the lease liability table. It's almost like the present value table, but with some illegal modifications. So we have got our year or year ended. The year ended. The first year was ending when? Obviously, was ending 31 December 2021. So we come here, 31 December 20x1. What was the balance BD? The opening balance. What was the cash flow? Here we are talking of the interest. Actually, cash flow here is the interest, isn't it? The interest at what percent? 5%. Interest at 5%. Then this interest is going to be reduced by the payments. Actually, the payments, it's good to just talk of the payments, the actual payments as the cash flows. All right, the cash flows, which are going to be paid. And these ones, the cash flows are the rentals, the actual rentals, which the lessee will be paying. And these have been determined in these ones. These are the amounts we are talking about. Okay, we did determine them initially here. That's where they come from. So it's just the same figure. So that's 9476. So you can fill out this column 9476, 9476 throughout, but we just want for the first year, right? For the first year alone. So what is the balance BD? The balance BD, the balance BD of the lease liability is this amount, okay, which we determined there for this one. 246,389. 246,389. So we multiply 5% of that one. I mean, that figure with 5% to get the interest charge. That's 12,319. 246,389 multiplied by 5% is equal to 12,319. All right. So what happens here is that we started with this opening balance and it is increased by the interest charge, 12,319, but it is subsequently reduced by the payment. These are the payments, the actual payments, and we will be having the balance CD. So what will be the figure then? We are saying 246,389 plus 246,389 plus 12,319 minus 90,476. We arrive at 168,232. 168,232. That's in year one. Now, the question that then comes is, how are you going to account for these figures? What do they mean? So, here's the accounting. In year one, we are going to debit the interest expense. Debit interest expense. How much? 12,319. This is the interest expense we are talking about. And crediting lease liability. The lease liability is increased by the lease payments. In a way, we are unwinding the discount, isn't it? So we are increasing with the same amount, 319. 12,319. That's the accounting for the interest expense. And Henry, when we make the payment here, the payment of 90,000, we are reducing the liability. So we are debiting liability, debiting lease liability with the same amount, 94,476, and we are crediting cash, because cash is leaving us as we make the lease payments or the rentals. Okay. Now, there is also the aspect of depreciation, because this asset is going to be there for 3 years. So the raw asset depreciation, the asset is for 3 years, but we recognized it at the cost here. This was the amount which we attributed to the raw, remember, the 246,389. So depreciation is going to be based on that one. Depreciation, that's debit depreciation, 246,389. Is it so? Yes, 246,389 over 3 years. This should be 246,389 over 3 years. That's 82,130. So in the first year, we are debiting depreciation, that is 82,130, and crediting. What are we crediting here? The accumulated depreciation, isn't it? Obviously, depreciation accumulates in the accumulated depreciation account. However, to be specific, in the SFP, in the SFP, the row is depreciating, isn't it? So the row is also going to be reduced by the same amount. Okay. So we are crediting the row with the same amount. So actually, in the SFP, under assets, the right of use assets is going to be 246,38389 minus the depreciation, which is this credit 82130. So in the SFP, that is 246,389 minus 82130. That's 164,259. An outstanding entry to be made, an irrelevant entry skipped. The maintenance cost, we talked about that one. That one was a straightaway P&L, where we said this amount is going to be debited. We debit the P&L, the maintenance cost, 9524. Yeah, here 9524, and credit the bank. So we are done. This question has been simplified. Let's look at this other example to see if we can make some sense out of it. On 1 January 2026, excuse me, my laptop is on the sun. On 1 January 2026, Russell entered into a 5-year finance lease. So this company enters into a 5-year finance lease, or this individual of a machinery. So the lease was of a machinery. The machinery has a useful life of 6 years. So you need to bear this in mind. The lease was a 5-year lease, but here the life of the asset is 6 years. So when you determine the depreciation, you need to know that we use the area of the lease term and the useful life of the item of the asset. So the area is 5 years. The annual lease payments are 5,000 per annum, with the first payment made on 1 January 2026. So we ended the contract on 1 January 2026, and we are required to make the first payment on that date. And we have established that this is a 5-year lease. 5-year lease payments start at year 0. So this one, we are paying in advance. The rentals are being paid in advance. So this one is an advance situation, not in arrears. This is in advance. In advance. So as you'll be reading the question, you'll be doing this switching, mood swinging. Yeah, you'll be very alert to the things, to the signals. To obtain the lease Russell, in case initial direct costs, this is more like it. In relation to the arrangement of the lease, but the lessor agrees to reimburse Russell 500 toward the cost of the lease. The rate implicit in the lease is 5%. The present value of the minimum lease payments is 22,000. In the ideal exam situation, nobody is going to do the computation of that figure for you. You need to lead yourself to compute it. So let us try to compute this figure. How did they arrive at this one? How did they arrive at this one? So we are told that this one is a 5-year lease, and every year we pay $5,000. So the present value of the lease liability, PV of lease liability is equal to the cash flow multiplied by the annuity factor 0 to 4 years. Yes. Annuity factor 0 to 4 years. If you simply pick the annuity factor for 5 years and multiply that one, you are going to get it wrong. Why? Because here we are having an annuity due, not an ordinary annuity. An ordinary annuity is that one that is going to be after a year. It's going to be due after a year. But this one is due today. It's an annuity due. The cash flows are starting today. They are not starting in the future. If the cash flows are going to start in the future, then we are having what is called an ordinary annuity. We are not teaching financial management, but this is the reality. This is the reality, guys. That's the reality. So we are starting to to make a payment today. So we are having an annuity due. Let me write it down. Annuity due. That's an annuity due, not an ordinary annuity. Okay, so what do? We come back here and say the cash flow. Cash flow is 5,000 multiplied by 1 plus ordinary annuity factor. 1 plus ordinary annuity factor. The ordinary annuity factor here we are looking for is the annuity factor at 5%, 5 years. Annuity factor 5%, 5 years. Let me try to look for that. Do I have an annuity table here? Let me check online. Oh, line. Okay, let me do justice to both of us, to you guys. Let me just keep this as I look for. Let me share something else here. Let me share something. Do I get this document? Is it readily available? Match tables. Hopefully, they will be there. I think the examiner is going to give us, yes, these are the annuities, the annuity tables. These are the annuity tables. So, if we go by the annuity, remember, we want the annuity factor. Since we are starting from year 0 to year 4, okay, it's year 0 to year 4. Why is it year 0 to year 4? Because the first payment is done in year 0, another one year 1, 2, 3, 4. It's a 5-year lease. So you need to count the 0 as the first payment, then payment at the start of year 1, another payment. So that will be 2, 3, 4, 5. So 5 payments. So when you come to the tables, All right. People are saying we are not seeing what you're saying. Say, cannot see. So let me just share. I'm sorry for that. I'm sorry. Somebody say, we are not seeing what you're saying, sir. I'm sorry for that. Anyway, so guys, this is the annuity table. Okay, this is the annuity table. Um, Sometimes the examiner provides you, but yeah, it's normally given in the exam. But sometimes the examiner might give you simplified figures or some factor you need to use, right? He might give you the two factors, okay, for the up to year 4 or up to year 5. So you need to lead yourself and understand what will be going on. What will be going on? So we say that the PV LM was going to be the cash flow multiplied by 1 plus a unit factor 0 to 4. Is that clear? Why are we using one? Why are we putting one first there? Or are we adding the one? This is because this is an annuity due. The payment is being done starting from year 0. Is that clear? Good. So the annuity factor for up to 4 years or up to the fourth year at 5%. Remember, we are using the 5% at 5%, which is our borrowing rate, 5%. So we go to year 4. Year 4 is this one. The factor is this one. So we are going to say this is equal to the cash flow was 5,000, 5,000, okay, multiplied by 1 plus 3, this one plus 3.546, which is equal to 5,000 multiplied by 4.546, and we must get, which is equal to, let me remove this one. Let me use my calculator. The calculator might not be on the screen, but let me use the computer here. 5,000 multiplied by 4.546. This comes to 2274. Excuse me. 22,730, right? Yeah, that's 730. Which is the amount we have been given. But what if you had, or you used to want to use the year 5? You want to use the year 5, what are you gonna do? Let us say they have given you that one, 4,329. So if you are given that one, simply means that, all right, if you are using, this is the ordinary annuity method. Ordinary annuity. So remember, you have been told that they are going to be 5-year. I mean, annual. They are going to be annual payments for 5 years. Yeah, because they are going to be made 5 times. Annual payments made 5 times. So you are still, within the same, the same era. So what do you do? What do you do? You are given the 5-year annuity at 5%. 5-year annuity factor at 5%. This is the figure we are talking about, 4,329. So what you have to do? What you have to do is that you are going to multiply the cash flow multiplied by the annuity factor, the ordinary annuity now, multiplied by 1 plus R. 1 plus R. Okay, so at annuity factor level, we want to come up with this amount, this annuity factor, the adjusted annuity factor. So we simply say the annuity factor, the ordinary annuity, which was 4.329 multiplied by 1 plus R. Our R is 5%. So that's multiplied by 1.05. And we should come. I've blocked the figures. No, they are not blocked. All right, so that's 4.329 multiplied by 1.05. We are having 4.545. So we are almost close. 4.54545. That's what we are having from my calculator here. It's just an issue of rounding. This is just an issue of rounding. All right. So you can see it's just the same. And you are likely, if you multiply this one by 5,000, the cash flow, you are still going to come somewhere closer. Just going to come somewhere closer. So if we say multiplied by 5,000, you come to 22,727.3, which is to some extent negligible. All right. So the best way is to use this one, but all the same, you would be somewhere closer. I hope I didn't confuse you guys. It is an annuity due. This is the best way to do it. Okay. You start with the cash flow. You say cash flow, which was the 5,000 every year, multiplied by 1 plus annuity factor from 0 to 4. That is because if it is being paid today. So you need to rest at the year before the total number of years. Here, the total number of years is 5. So you need to rest up to the year before the 5. If it was a 6-year annuity, then you are going to rest at 5. Why? Because the first year is 0. I said my own. If you fail, then that is your own baby. I'm no longer the problem. I won't be the problem there. Please excuse me. Okay, let me then unshare and reshare my work. Further lease accounting. I think we need to finish this one. Okay, I was talking about I was trying to prove a point of where we obtained this one. I'm sorry, I'd forgotten. I'm getting old, being in an angle, remember. So we have shown you how to come up with that figure. If the examiner didn't do it for you, you need to know how to come up with the figure. And I've shown you all the angles, all the dead tricks and white tricks and clean tricks, all in one. Okay, now let us now demonstrate how this lease will be accounted for in the financial statements over the 5-year period. All right. And like I said, all this information is not going to be given to you. No one is going to tell you over the 5-year period or what, because you need to lead yourself to see that this lease is a 5-year lease, just using the principle, using the principles. All right. So first of all, we need to recognize the right of use asset as the equivalent amount to the lease liability, which we would have calculated, and the right of use will also be the same amount. However, the right of use in the SFP would be increasing in value because they are, you see, the right of use here. Initially, we had recognized at 22730, but it is going to be increased by the the initial direct costs, which are 1,000. So we need to add the 1,000 there. Also, it is going to be reduced by the incentive. The lessor said that he's going to reimburse us $500, so it will be reduced by $500. So what is the total there? The rate of use will be the 2,730 plus 1,000 minus 500, and it will come to 23,230. That's the right of use. But the lease liability now, the liability side, the lease liability would be this is at the start. Actually, this is at inception, not at the year end. So at inception, the lease liability would be the 22730. The figure we were told, this was the present value of the minimum lease payments. Is that clear? That is at inception. At inception. Okay, but subsequently something will happen. Okay, subsequently something will happen. Since at inception the role had increased in value, we are going to depreciate it with the new value. All right. So we are going to depreciate it with the same value which had increased this amount. So over the lease term, that is the 5-year term. How do we determine the lease term? I mean, for depreciation purposes, the lease term would be the earlier of the lease term and the useful life of the asset. So the earlier of the two. So this means, because the useful life is 6 years, but the lease term is 5 years. So we are going to take the earlier, which is the lease term, which is 5 years, and we charge depreciation of that amount. So if we charge depreciation of this amount, it means that at the end of the year, this row at year end, the row will be reduced by the depreciation of 4646, which means it will cease to be 23,230, but something lower at year end. At year end, it would be at year end, it will be 2,330. I mean 230. 230 minus 4646. So at year end, it will be 18,584. That will be the movement. That will be the dynamics. Now, we also have to factor in. So the SPL, actually, the SPL would be having the depreciation, under operating expenses, depreciation, but depending, because the examiner is going to tell you whether depreciation is going to be recognized in cost of sales or in operating expense. The examiner is going to be clear there. Be also mindful of IFRS 18. This is why I'm talking of operating expenses. So depreciation under the operating expenses would be 4646. I'm thinking in my mind of the pre-populated spreadsheet where you would be putting these figures. So I'm thinking of the financial statements as a whole in the SPL, in the SFP. Where do we put this? Where do we put that? All in one. Okay. Then after the depreciation, we are going to also talk of finance costs. I mean, interest expenses. The interest expense from lease liabilities. Those have to be presented. Those have to be presented separately from normal borrowings, isn't it? From normal borrowings. Okay. So the interest expense. But for you to get the interest expense, you need to do the amortization table. You need to do the amortization table. And that will be based on this figure, the initial figure. So you need to subject that figure to the lease liability, the lease amortization table. We start with the year, then the cash flow. After the cash flow, we talk of the rate, the coupon rate. See the coupon rate. Okay, so the interest interest charge, interest at what? At 5%. Okay. Now, I'd forgotten one important point where we talked of the annuity due issues. All right, so the payments here are made in advance. So this amortization table should be modified a bit. So we need to have actually our balance brought forward. Balance PD. Before we factor in any interest, we will start with the payments. All right, so we have a balance brought forward, which is the opening balance, right? And then we pay first at the start of the year. And then we move on to what can be the interim balance, or let me just say the capital balance. Because we need to levy levy interest on the capital balance. Then we have got the interest at 5%. Then we have the closing balance, the balancing CD. So since we are starting at the first year, which is our year zero, then year 1, year 2, year 3, year 4. We need to pick the opening balance as agreed, as we have already determined, which is 22,730. Okay, then payments, we pay 5,000 each time we make a payment, isn't it? That's 5,000 per annum. So we are going to deduct 5,000 from that amount to reduce the liability, and we arrive at, let me use this calculator of mine. So we have got 17,000 here. That's 22,730 minus 5,000. That's 17,730. Then we subject that amount to 5% interest cost or finance cost. So we come to 887. And this amount is going to increase the capital balance there from 17,730 to 18,670. Obviously, when I say year zero, okay, one would ask and say, can we have year zero in our books? No, we don't have a year. Year zero simply means the current year, but the lease payments are being made at the start of the lease. So this is actually 2x1. Is it 2x1? The year under review? No, it's 2x6. 2x6, year 2x6. If you want to be very, very exact, year 2x6, and this is year 2x7, and 2x8, 2x9, 20, y0. The fifth year. Or you can even say year 1, year 2, year 3, year 4. It is allowed, isn't it? You can even say year 1, year 2, year 3, year 4, year 5. It is allowed as long as you know what you are doing. As long as you know what you are doing. Then we take this CD up here, 18,617. We deduct 5,000 from it, and we come to 13,617. We charge 5%. Comes to 6. The 5% of that one is at 681. And this increases the capital balance to 14,298. We take the 14,298 here, and we reduce by 5,000. These are 5,000, and we come to 14 minus 5. That's 9, isn't it? 9,298. Then you multiply by 5% of that. That's 465. 465, and that increases the capital balance to 9763. We take the 9763 and we reduce it by 5,000. Come to 4,763. Then we charge 5% on that, which is 237. And we increase that amount to 5,000. We take the 5,000 here. All right. Take the 5,000 to that side, and we arrive, make a payment of 5,000, and we are done. The capital balance is 0 now, because 5,000 minus 5,000, that's 0. And we are done. That's the end of the whole thing. So how do we determine the interest expense? What is the interest expense for year 1? The interest expense for year 1 is this one. This is the interest expense for year 1. So you need to, the interest expense was uh, 887. That it is under that category for financing activities. Okay, financing activities. Um, Let me look for, just for interest sake, for the technical article on IFRS 18, so that we are always alert on the requirements, especially the aspect on presentation. This is something like it. So the interest expenses on borrowings should be presented there in the first line on interest expenses on borrowings. I think that's where the lease liabilities, interest related to lease liabilities should be put. Let me look for the more clearer one. Something that I think there was. You guys are not seeing anything, or I always forget. I always forget you. I was referring to this, uh, statement of financial performance by the examiner, and I was saying that interests have to appear after the profit before financing and income taxes in the new presentation format. And there are two forms of interest expenses, the ones relating to borrowings and the others relating to pension liabilities. Although they both belong to financing costs or financing expenses, they need to be presented separately. All right. So I'm looking for the examiner article where these presentations were pronounced clearly. So let me try to look for, yeah, this is the article. All right. And I'm sure this one, yeah. So I was right. So you can see, I'm sure you guys can see. Let me share it clearly so that you guys, I'm sure, yes, I'm actually spot on. So I have some annotations. All right. So we are talking of lease liabilities, and they have to appear on borrowings and lease liability, interest expenses on borrowings and lease liabilities. I'm sure you're seeing that. That's where you need to input these interest expenses in the statement of financial performance. That is the statement of profit or loss portion under the income and expenses from financing activities. So that's where you need to put. This one is actually in line with IFRS 8. All right, this is in line with IFRS 8. Hello, daughter. Yes. How are you? Okay. Thank you. So, let us get back to our business. Um, So what then happens is that as we create the interest, then this interest, as we recognize the interest expense, we also have to increase the lease liability. The lease liability is increased by the same amount, so we add the interest expense, 887, okay, minus any payment, the payment of 5,000. So it means that in the SFP, the ultimate at the end of the year, we should have let me just do the computations. In the SFP, would have 22,730 plus 22,730 plus 887 minus 5,000. We come to 18,617 as the lease liability at the end of year one. Let us confirm from the lease table to see if we are right. This is the amount we are talking about. 18,617, and this is the amount we are having. One might be, interested in knowing or in splitting this liability into current and non-current portions. All right. So at the end of year one, we said that this is the total liability. But of this one, only 5,000 has to be paid in the next year or in one year's time. So that portion is the current liability, and this is the payment, the 5,000 payment, which is due. That one is due in a year's time. And the remainder will be paid later on. So if you add these two, we will still come to this. So in the year 2001, in the first year, at the end of the year 2001, at reporting time, they would have this current liability of 5,000. They need to pay it as soon within 1 year, and the 13,600 is a non-current liability. If you want to be pedantic, you want to separate these two. Okay, but that is going too far with the question, isn't it? That's going too far. Okay, so that's how, guys, the question was supposed to be treated. Do we have to do this one together again? Oh, getting tired. Okay, I think we will break for now. So guys, we have actually covered a mile, and we are almost midway to what we intend to achieve in this video. Let us now do a further example on lease accounting to then seal the whole enterprise into one bundle. So please be with me towards the whole journey. So on 1 January 2026, ACCA entered into a 2-year lease. This was a 2-year lease, ladies and gentlemen. 2-year lease for a lorry. The contract contains an option to extend the lease term for a further year. So there was an option to extend. ACCA believes that it is reasonably certain to exercise this option. Lorries have a useful life of 10 years. So there is an option to extend the contract from 2 to 3 years, right? So we now have got 3 years in picture, which are the lease term. But the useful life of lorries is 10 years. But we now know, at this juncture, we now know that we are going to use the earlier for our depreciation computations. So we are going to use 3 years, and the lease term is going to be considered 3 years, right? Not only for depreciation, but the lease term here, the non-cancelable period is 3 years, all right? Why? Because the tenant, the lessee, is reasonably certain that they will be still in business and willing to participate in the contract for 3 years. Lease payments are 10,000 per year, so these are the constant payments every year. For the initial lease term, which is for the first 2 years, they will be paying 10,000 per year, but 15,000 per year for the extended period or the option period. All payments are due at the end of the year. So this one is a typical case for an ordinary annuity. To obtain the lease, ACCA incurs initial direct costs of 3,000. These have to be capitalized, have to be debited to the ROI, to the ROW, right of use asset. The lessor immediately reimburses 1,000. So this one is a reduction of the ROW. The interest rate within the lease is not readily determinable. ACCA's incremental borrowing rate is 5%, which is allowed by the standard. You can use the incremental borrowing rate, and we talked about this rate earlier on in the video. Required: calculate the initial carrying amount of the lease liability and the right of use asset, and provide the double entries needed to record. So now here you can't use the trick of the annuity. Why? Because these are the amounts are different. You can use the annuity trick for the first 2 years and then come back to the discount table, the present value tables. I think here, since the number of years is just 3 years, we can just use the present value table. So determination of the lease liability, or just say the PV of the lease liability. The PV of the lease liability, we've got year, we've got the cash flow, we've got the discount factor at, what is the rate here? They're using 5%, at 5%. Then we've got our present value. So year 1, cash flow is 10,000. Year 2, 10,000. Year 3, 15,000. Discount factor of 5%. This is 1 over 1 plus R to the power 1. And this one is 1 over 1.5 to the power 2. And this one again, 1 over 1.5 to the power 3. Very, very simple, isn't it? With my calculator. So, that's 10,000, 10,000 multiplied by 1 over 1.5, 0.05. This comes to 95, excuse me, 9523. Then we say 10,000 multiplied by 1 over 1.05. Again, 10,000 over 1 point. Actually, say it's refusing. This calculator of mine is not learned, isn't it? 10,000 over 1.05 to the power 2. That's 9070. Then the last one, the last match. The last match. Can see, guys, there's a lot of working here. Okay, that's 15,000 divided by, oh my God, 15,000 divided by 1.05 to the power 3. That's 12,958. So we add up and we get the PV, which is our lease liability. The lease liability is the total, ladies and gentlemen. Now, do not mind about the accuracy of the figures because the type of calculator I'm using might be an error. But just get the logic. 9070, 9523 plus 9070 plus 12,958. That's 31,551. That is the lease liability, ladies and gentlemen, and we were required to also come up with the journals, and these are the journals we debit right of use assets with how much is the equivalent amount, 31,551, and credit lease liability with that 31,551. As simple as that. Still at inception, there are other journals we need to make because we were told that this ACCA was required to meet some direct costs of 3,000. So we also have to debit right of use asset. It's 3,000. We debit right of use asset with 3,000, and we are crediting cash. We are not increasing the liability with this amount. No, we don't increase this. The lease liability with this amount. Please be careful there. Then there was also a refund. We were expecting some refund. These costs are not expensed. Please, these direct costs are linked to the asset, to the lease. To the right of use asset. They are not found in the statement of profit or loss. Okay, what about the payment? Is it income? The payment we are going to receive, is it income? What is the double end? The double end there is that we are going to debit we are crediting row. We are reducing the row with that amount, but we are debiting cash. We are receiving money. We are receiving money, but at the same time, we are reducing the asset. No profit or loss there. All right. There's no profit or loss there. Okay, these transactions, they do not affect any profit or loss, no profit or loss movement, no profit or loss impact. You haven't sold anything, you haven't, although you have incurred the cost, but it is only impacting your row. It is increasing. The cost which you would have increased are increasing your right of use asset. Okay, so the cost is increasing the right of use asset here, but here, this one is a refund, or this one is called an incentive, lease incentive. They are being incentivized by the landlord. So that refund is going to just impact your cash and decrease your right of use asset by $1,000. Okay, now we have done all the modalities at inception. I think we have attended all the requirements of part 1. We determined the right of use asset, the lease liability, and the right of use asset. We determined both of them here and come up with the journals, the journal for that, and the journal for the direct costs which they incurred, okay, where we are debiting raw and crediting cash. All right, and then we came to the incentive where they were being reimbursed something by the landlord, which is something fine. We have done that part. What about the second part? The second part is we need to explain the subsequent treatment of ACCA's lease in the year ended 31 December 20x6. 31 December 20x6. So this is what we're gonna do. This is what we gotta do. So we need to come up with the lease table, lease amortization table. The lease amortization table, this one we are paying in arrears. So that's not a big deal. We've got the year, we've got the balance brought forward. We have got the interest at 5%. We've got the payment made. We have got the closing. Year 1, year 2, year 3. So the balance BT is the lease liability figure, which we initially calculated, and this was this amount. So that's 31551. Then we subject this to 5%. What is the 5% of that one? My phone is too far. Honey, where are you? Honey, where are you? Where are you? Honey, 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 where are you? So 31, 551. To calculate 31, 551 multiplied by 5%. We come to 1578. And we made payment. The first payment was 10,000. This is the payment. The purpose of the payment is to reduce the liability, whereas the interest here is increasing the liability. Okay. Initially, the liability was 31,551 at inception. However, the interest increases the liability. All right. And it is then subsequently reduced by the payment. So this means that if we say 31,551 plus 1578 minus 157 minus 10,000, we come to 23,129. And we take the 23,129 as our opening balance. And we charge 5% again. Comes to 1,156. So 23,129 plus 1,156 minus 10,000. We rest at 14,285. 14,285. Okay. This information is sufficient to answer the first requirement. Explain the subsequent treatment of each case list in year and 31 December 2026. So we will have listed our years in that order: 20x6, 20x7, 20x8. So we'll do the same here. That's 20x6, 20x7, 20x8. Just to avoid confusion, to prevent confusion. Okay, now, so we have determined the interest. For the interest, the double entry there. For the interest, we're gonna say debit interest expense for 2006, that's 15,778. And crediting lease liability. This one increases the liability. As we have seen, the balance of the liability was this one, but it was increased by the interest. The interest increases the liability. Then for the payment, the payment has got the impact of reducing the liability. So we are debiting the liability, isn't it? Debit LL by 10,000 and credit cash. Money is leaving our bank. All right. Then in the statement of financial position, you would see that although initially our lease liability was 31,551, it is going to be reduced by that, but subsequently it will be reduced by 10,000, and we will be having 23,129 as our closing balance for the lease liability. However, you may go pedantic to present the current liability on its own and the non-current liability on its own. Is that clear? So the current liability is actually this lease payment. Obviously, this one has already been paid, but this one for year two, this payment is a current liability, and the the difference, okay, the difference between 23,129 and 10 will become the non-current liability. This one is the amount that is due in the next year. All right, it has to be paid. So this one will be there. If you want to separate, so the difference between the two becomes your non-current liability. However, that one will be going an extra mile, isn't it? All right, guys. I think we did justice there. Somebody is saying that we didn't talk of depreciation. Yes, we didn't talk about that, which is some omission on our part. Yes, this was a three-year lease term, which means the raw aspect. The raw aspects, we need to talk of the raw. Okay. The raw, we have depreciation on the raw. Depreciation is based on the raw. What is now the raw? The raw is, we are having the first amount we recognized was 31551. 31551 plus, remember the direct cost, where we ended up debiting the row again, that is increasing the row by 3,000. This direct cost is part of the row. Then the incentive of 1,000 is the deduction, okay? The total divided by 3 years. Okay, that's 31554. 31551 plus 3,000 minus 1,000. We arrive at okay, we arrive at 31. 33,551 divided by 3. This means we have 11,183.67. So that's the depreciation charge. And we are going to debit We are debiting depreciation, 11,183.67, crediting row, 11,183.67. We are reducing row by the depreciation. So in the SFP, our row initially so in the SFP, the row will be 31,551 plus 3,000 minus that one minus the depreciation. So that's 31,551 plus 3,000 minus 1,000 minus the depreciation of 11,183.67. The 1,551 plus 3,000 minus 1,000 minus 11,184. So that's 22,367. 22,367. That is the SFP at the end of year one for row. That's our row. What about the lease liability? The lease liability for the LL, we have already determined it. Okay, the LL, the liability, we have already determined that this is the lease liability at the end of the year, 23,129. Okay, and if you want to then say the current liability portion, obviously is the payment required. That's the liability. The current portion is 10,000 minus 23,000, which means the non-current will be 13,129. Is that clear? Now, let's talk of lease accounting in the lessor. That's lessor accounting. The lessor sometimes does the same as above and calls this finance lease accounting, and sometimes puts a simple operating income straight into profit loss and calls this operating lease accounting. The test distinguishing between these two is as follows. The test distinction between these two is as follows. Risk and rewards of ownership with user, that is lessee, owner, lessor. So if there is transfer of risks and rewards from the lessor to the user, then this is accounted for as a finance lease. In the books of the lessor, if all the risks and rewards associated with the property are transferred, all the maintenance, everything is just being done by the tenant, then that would be a finance lease. Remember, it is the lessor who is allowed to make the distinction in his books whether he treats the lessee as a finance lease or an operating lease. If the recent rewards are being transferred to the lessee, then that is a finance lease. But if the risks and rewards associated with this with the owner then the lease is an operating lease. The owner still bears the risks, so it is an operating lease. Classification of the lease summary. It is a finance lease if risks and rewards of ownership are transferred to leasee. We've spoken about this. Ownership passes at end of the lease term if the ownership of the asset is also going to pass at the end of the lease term. If ownership is going to pass to the leasee, that's again a finance lease. If there is an option to purchase asset at a below fair value at end of the lease and reasonably certain option will be exercised, is still a finance lease. Lease term represents the major part of the asset's economic life. That's again an indication that this is a finance lease. The majority of the useful life of the asset is going to be consumed by the lease. The majority of the asset's useful life is going to be consumed during the lease. Then that's a finance lease. The present value of minimum lease payment represents substantially all of the asset's fair value. That's a finance lease. Lease the asset is specialized in nature. That's a finance lease. On the other hand, operating lease accounting, operating lease income receipts are recognized as income through P&L on a straight line basis. Depreciation on the asset continues over its useful life. Why is depreciation continuing? Because in an operating lease situation, the lessor continues to have the asset in his records. But in a finance lease situation, all the risk and rewards associated with the asset are transferred to the lessee. Therefore, the owner relinquishes ownership. In substance over form, you would have given the asset to the tenant. Is that clear? Good. So he de-recognizes the asset from his books in a finance lease. Let's look at this example. We have got Kayla here. Kayla leases out a machine to Brim under a 4-year operating lease. The terms of the lease are that the annual lease rentals are $2,000, payable in arrears. As an incentive, Kayla grants Brim a rent-free period in the first year. Explain how Kayla would account for the lease in the financial statements. Income of $1,500 would be recognized through profit or loss for each of the 4-year lease. We have determined that, how this come by, isn't it? Because remember, we had that situation of Gogo and Ranko, right? So there are 4 years here for this lease term. However, the first year is free, but the second, third, and fourth are payable. So you say 2,000 multiplied by 3 and you get 6,000. And they say 6,000 divided by 4. Even if the first year was free, it is considered as part of the lease term. So there is 1,500, isn't it, per year? So this is why we are saying income of 1,500 would be recognized through profit or loss for each of the 4-year lease. Now, this is now income in the lessor's books. It was an expense during the Rango period, but now it is income in the lessor, in the landlord's books. At the end of year 1, accrued income. Previously, it was an accrued expense in accrual, but this time around, it's accrued income. Would be recognized on the statement of financial position, of which 500 would be released over the remaining 3 years of the lease. Please replay that part of the video to get the idea of what we are talking about. Finance lease accounting. They recognize asset and record a receivable at net investment in the lease. Record finance lease receipts as a reduction in the receivable. Record interest income on the receivable. Net investment in the lease is equal to gross investment in the lease discounted at the implicit rate of interest. Gross investment in the lease is equal to minimum lease payments receivable plus any unguaranteed residual value. Unguaranteed residual value. So you need to recognize the asset and record a receivable at net investment in the lease. And the net investment is the gross investment in the lease discounted at the implicit rate of interest, right? And gross investment in the lease is equal to minimum lease payments receivable plus unguaranteed residual value. All right, so it's almost like the inverse of the lease liability, but this time around it is now a lease receivable. It is now a lease receivable. Now, finance lease, Caro leases out an item of property, plant, and equipment under a 5-year finance lease. The lease commenced on 1 January 2015, and the rate implicit in the lease is 4%. The annual lease rentals of $5,000 are paid at the start of the lease period. Caro estimates that the unguaranteed residual value of the PPE is $400. Calculate Caro's net investment in the lease. Caro's net investment in the lease. So we need to ask ourselves, what is the net investment? By definition, what is it? It is the gross investment in the lease discounted at the implicit rate of interest. All right. So gross investment is the minimum lease payments receivable plus any unguaranteed residual value. So what are the lease payments receivable? The lease commenced on 1 January 20X5, and the rate implicit in the lease is 4%. The annual lease rentals of $5,000 are paid at the start of the lease period. So these ones are paid at the start of the lease period. 5,000, 5,000. Caro estimates that the unguaranteed residual value of the PPE is would be somewhere, or this is actually the salvage value, or just the residual value we used to know. We used to know in IS 16 PPE, right? The scrap value, salvage value, something like that. So, but this one is unguaranteed. Unguaranteed simply means that a rough estimate of what we can get at the end of the lease period is $400. So we account for that as income, isn't it? We account for it as income. So how many years are we talking about here? We are talking of 5 good years. So we're going to receive 5,000, 5,000, 5,000, 5,000, 5,000, and then $400. Is that clear? Good. But we need to bear in mind, it is better to utilize the zero. Sometimes you'll be confused. Utilizing the zero in creating the table is most judicious, because sometimes you might end up confusing yourself with some of the figures which you might want to use. So we come with our table. We've got here 0, 1, 2, 3, 4. We might have 5 to cater for the salvage value. Okay, the 5 as to cater for the salvage value. Okay, now, so if we have the year, we can have the cash flow, the discount factor at 4%. And then we have our present value. Remember, the net investment is the present value, isn't it? It's the gross investment in the list discounted at the implicit rate. Discounted simply means it is a present value. So in year 0, we receive 5,000. Year 1, 5,000. Why are we saying year 0? Because these payments are paid at the start of the lease period, at the start. Year 2, 5,000. Year 3, 5,000. Year 4, 5,000. So these are now 5 years, isn't it? But the salvage value cannot be added here. Some lazy students will simply add it on the last 5,000 there. That's wrong, because the salvage value is strictly at the end. The meaning of residual value is at the end of the lease, not at the start of year 5, but at the end of year 5. Am I talking to someone? It's at the end of year 5. So this is why you need to put it here. So discount factors, I have the table here. You can utilize your own table there. All right, the discount table. I mean the discount factors, the present value tables. They can be downloaded online. So I have mine here. So year 0, the discount factor or unit factor is 1. For year 0, excuse me, the unit factor or discount factor is 1. Okay, just know that by memory, isn't it? Then we have got 0.962, 0.962, 0.925. That's for year 2. For year 3, 0.889. Year 4, 0.855. Year 5, 0.822. Then you simply multiply across. Obviously, for the first year, that's 5,000. This is year 0, and you can't discount an amount you have received today. No time value of money. So it is still the same amount. This is why it is coming up as just 5,000, because it is being paid in year 0 at the start of the year. No time value of money has applied. Then 5,000 multiplied by 0.962, this comes to 4810. Then 5,000 multiplied by 0.925, this comes to 4625. Then 5,000 multiplied by 0.889, this comes to 4445. Then 5,000 multiplied by 0.855. That's 4275. Then 400 multiplied by 0.822, that's 3.29. I mean 329 actually. Then you have to add up all those figures. you add up all those figures and you must arrive at 23,485. 23,484. That's the present value, which is the net investment in the lease. Ladies and gentlemen, I hope we have done. Ladies and gentlemen, I hope we have done justice to ourselves so far in as much as IFRS 16 is concerned. But there is still one thing we need to look at: sale and leaseback situations. These ones often come in our examination, and it is our duty to show examiners that we are ready to tackle whatever situation relating to IFRS 16. So let us jump in. Sale and leaseback transactions. The Leases standard IFRS 16 distinguishes between the two forms of sale and leaseback by reference to the revenue standard, that is IFRS 15, a revenue from contracts with customers. The revenue standard does a test for commercial substance. The two standards working together then show that a sale followed a leaseback that covers most of the asset's life is not a sale at all. So for us to see whether the sale was genuine, we need to be informed by the criteria of a sale according to IFRS 15. So if the transaction fails to satisfy the test, then it may not be, a leaseback transaction. All right. The resulting transaction might not be a lease. All right. Or might not be a sale. Because somebody might be the owner of the property. They decide to dispose of it and then continue to occupy the property. So we need to determine how to deal with the property in our records. Shall we de-recognize the property, or shall we continue to recognize it? The revenue standard is arguing that you have not sold something if you keep the majority of its risks and rewards. So we will be informed by the concept of risk and reward. Risk, excuse me. I want to have a pen somewhere. Good. So we are talking of risks and rewards. This form of transaction is then identified as a secured loan. That is IFRS 9. IFRS 9. If it fails to satisfy the sale, then in a way we might look at the transaction and say, no, this was just a loan arrangement where the building in question or the asset in question was only used for collateral. So this gives two forms of sale and leaseback: A, real sale, and real leaseback. Here, the risks and rewards transfer out during the sale, and stay out during the leaseback. So the sale is recorded as a sale and the lease is recorded as a lease. All right? Where the sale itself was genuine and the leaseback was actually a genuine lease. Now, in part B, we have a fake sale and a fake leaseback. Here, the risks and rewards transfer out during the sale, then come straight back. In their majority, they come straight back in again during the finance leaseback. So the sale is not a sale, and the sale proceeds are not sale proceeds. They are loan proceeds. But remember, we are told that there are two forms of sale and leaseback. There is a genuine sale and leaseback and a fake one. Now, somebody might ask and say, what if the sale was genuine, but the leaseback was fake? Can that happen? You still have to be guided by the principle that it is either a genuine in everything and a fake in everything. Yeah, that's the idea, isn't it? Because it is very, very difficult to prove that the sale would be fake. I mean, the leaseback would be fake because a fake leaseback on its own would be a fake lease, and if it is a fake lease, it means that it fails to satisfy the conditions of the lease. We have been taught of the conditions or the criteria for one to recognize that a lease is in operation. At the start of this video, we talked about that, isn't it? Situations where we need to identify an identifiable asset. Okay, we need to identify the leased asset. We need to identify the period. We need to identify the commercial substance. That is, there should be a consideration to be transferred in exchange for the right of use. And there should be the conveyance of control, of the right of control of the use of the property. All those things. So, if it was a genuine sale, but then, after you sold something, you then lease it back and start to stay there without paying any rent, then without any consideration in exchange for the use, then there is no lease. There's no lease. You cease to recognize the lease. That automatically it will stop. It will still come to the same aspect of a fake sale. It was a fake sale and fake lease. Do you get it? What about in a fake sale and genuine lease? Can that happen? remember, we are talking of a situation where you are already a lessee. You are already, you are already the owner of the building. Okay, in a sale and leaseback, you are already the owner of the building. So you sell the building and then start to lease it back. So can it happen that you enter into a genuine sale and then start to have a fake? Okay, I've explained that. Okay, what about a situation where you enter into a fake sale and then start to do a genuine lease back? Can that happen? It can happen, isn't it? Because you are already the owner. So you made a fake transaction, a fake sale transaction, all right, fake sale transaction, and then you start to genuinely pay rentals, it won't happen, isn't it? Because you are already the owner. How can you then start to pay rent when there was a fake sale, which means there was no sale that happened, right? No sale that happened, and you are now starting to pay, you know, rent to who now? Because there was no sale in the first place. So these ones are just the only genuine possibilities in this situation. Either a real sale, real leaseback, or a fake sale and fake leaseback. Are we together now? We are settled. That the issue is settled, isn't it? Now, if you annotate with these guys, you then have to remove these. All right, that's fine. If the transfer of the asset is not a sale, then the following rules apply. If the transfer of the asset is not a sale, seller, lessee. If there was no sale, the seller, who is now the lessee, should continue to recognize the asset, should then recognize a financial liability if he obtains any money. If he obtains any money, he just have to, you know, recognize a liability. Why a liability? Because in that situation, whatever money he obtained was just a simple loan. He had borrowed money. He had just borrowed money and used his property as collateral. So you need to recognize a liability, but at the same time, continue to recognize his asset the way he was recognizing it. Now, what about the buyer lessor? The buyer, who is now the lessor in question. He shouldn't recognize any asset because there was no sale. He did not buy anything. He just gave somebody money, and he just have to expect. His duty is to expect some money back when the guy he gave money to decides to pay him. So he has got a financial asset on the future proceeds to come. Is that clear? When the money is repaid, he gets his money back, but he has no asset to recognize in his books. Is that clear? Now, if the transfer of the asset is a genuine sale, then the following rules apply. Seller lessee. The seller has to de-recognize the asset, yes, because genuinely he sold it out or away. Then recognize the sale at fair value. Recognize, lease liability because he's now leasing back. Excuse me. So recognize lease liability, which is the present value of lease rentals. It's normal, isn't it? Recognize a right of use asset as a proportion of the previous carrying value of underlying asset. Gain or loss on rights transferred to the buyer. So the gain or loss on rights transferred to the buyer should also be recognized. Usually, when you sell something, obviously there would be some gains or losses, isn't it? And those should be recognized. Obviously, we recognize them in the statement of profit or loss, isn't it? Good. Now, what about the buyer lessor? He recognized purchase of the asset, right? You need to recognize this purchase of the asset and apply lessor accounting depending on whether he chooses to account for the transaction as an operating or as a finance lease. So lessor accounting. Remember, lessors are allowed to have a choice there. depending on the characteristics of the lease itself. Is it warranting an operating or a finance lease? We have discussed about those situations or metrics you can use to determine whether it is a finance lease or an operating lease. Please replay that part of the video. We have an example here. Yes, let us look at this example and concentrate, because this example is, exam standard. We have got a guy called Tego. Tego has had 2 sale and leaseback transactions during the year. 2 sale and leaseback transactions during the year. They both relate to property. The first involves a leaseback contract for 20 years on a warehouse believed to have a life of roughly the same duration. So the life of the lease was also equal to the life of the warehouse, the useful life of the warehouse. The second involves a short contract of only 5 years on a property known to have a life which was much longer. The discounted present value of the lease obligation is 5 million. So 5 million for this second one. Okay. Actually, in either cases, the present value of lease obligation is 5 million. So let us look at the additional information. Situation number 1, sell and lease back. The lease life and asset life, both 20 years. Sales proceeds 30 million. The fair value of the warehouse, 30 million. And the book value, 23 million. Okay. But the obligation, this guy is only going to meet 5 million in this situation. He's only going to pay 5 million. Hello? When the fair value of the asset is 30 million, the sole proceeds 30 million. Asset is having a life of 20 years. The useful life of the asset is 20 years. The lease life is also 20 years. So he is only paying an obligation of 5 million. Was this a sale, or it was just a simple loan arrangement? In terms of the commercial substance of the transaction, I feel the first situation is a suspect. There is no right or wrong answer, especially when the information is scanty. But I do believe that you need to come up with some reasonable facts. For example, the obligation, if somebody enter into a sale and leaseback in this situation, the obligation is only 5 million against the fair value of 30. The present value of lease payments, future lease payments, we expected here. Remember, he is consuming the rest of the rest of the asset's life. At the end of the lease, that will be the end of the asset's life. So almost about 1/6, 1/6 of the asset's life. I feel this wasn't a genuine sale and leaseback, given that information alone. I feel this wasn't a genuine leaseback, sale and leaseback transaction. The 5 million is too small an obligation in this situation. So, in a way, the seller was using the property to attract a loan. That's my conclusion here, that this wasn't a genuine sale. It fails. It fails to be genuine enough in terms of the lease recognition of commercial substance. Okay, the commercial substance, especially of IFRS 15 of a sale. Okay, yeah, one might argue and say, in terms of the sale, this was genuine. But now, in terms of the consideration in the lease, seems to be too small to be a genuine lease. To me, seems to be not at market significance or market value. That's too far below the market value. Remember, the fair value here is talking of 30 million, but here the obligation is just 5 million. To me, it doesn't sound proper. What about the situation number 2? Situation 2, here it's a 5-year lease, 5 years, and this asset is said to be having a life which is much longer than than one above. So this could be actually a genuine arrangement, a genuine business arrangement. All right. So the obligation could be, justified here. 5 million for 5 years. So here we need to recognize the assets. I mean, we need to yes, recognize the asset and then recognize at least a right of use asset, which in which case, in A, we can't recognize the asset, we continue to have it, then recognize a loan. Okay? Actually, this is how it is presented, that we need to recognize a loan, that is a debit bank. We are debiting bank because we are receiving money, the proceeds, and crediting the loan. It's just a simple loan of 30 million. This guy was given money for 30 million. And that 5 million will be interest. It's an interest charge. Is that clear? The 5 million he would be paying. That's an interest charge. Is that clear? But now, in situation 2, sell and lease, it is a sell and lease with combined proceeds of 5 million. 50 million. Okay. So proceeds of 50 million. The book value of the property was 42. Okay. What about the fair value? Fair value, that's 50, which is fine. Now, the combined cash received is 50 million, and the liability, the lease liability, is 5 million. So the rest, 45 million, the 45 million, that is 50 minus 5, must be sale proceeds, meaning that 90% of the asset, 90% of the asset must have been sold. Why 95? 90%, that's 45 over 50, which is 90%. So we record the derecognition of 90%, right, of PPE, and the balance is profit on sale of 90% of the property, which itself is 90% of the profit that would have been recorded had the whole property been sold. All right. So that's 50 minus 42. Remember, the 42 is the NBV, the net book value, which we have seen the net book value. So this is the profit which would have been recorded. So we are going to debit bank as given because we received 50. We credit the lease liability, which is the 5 million obligation. Okay, and PPE, 90% of 42. Remember, 42 was the net book value of the property. 90% of that one is 37.8, and the remainder would be the balance, which is the balancing figure. Remember, the standard allows some alternative interpretation of IFRS 16, and you just have to disclose your assumptions, isn't it? You need to disclose your assumptions as to how you have treated. But the major part is that you need to be able to determine if the arrangement was a real sale and a real sale, a lease back or otherwise. As we did here, the second part proved to be so. Is that clear? But remember, this is very, very important, very important. You need to justify why you are coming up with those computations. All right. All right, guys, I hope this exercise on leases has been fruitful to you. If you are new to the channel, please do not forget to subscribe, like, and share and comment so that the videos go viral. Anyway, see you in week 7. Thank you. Danku, I'm signing out.